Good morning. First, thanks so much to Garfield County and Colorado Mesa University for hosting such a valuable event for local governments and for asking DOLA to be a part of it. This morning, here's the outline. I want to hit several things and end with some thoughts on the volatility of severance tax and where the forecasts look in the next couple of years. The Department of Local Affairs, or DOLA, has 4 divisions, and kind of built into our legislative declaration is how we like to see ourselves as a bridge to state resources and state assistance for local communities and local governments. I am in the Division of Local Government, and within the division, we provide technical assistance to local governments, local government capacity building, a wealth of research and demographic data through our demography office. The state demographer is housed within the Division of Local Government. Community development through efforts such as the Main Street program, of which the City of Rifle is a member of that program. And then finally, financial assistance. And in fact, in the division, there are 22 different ways for local governments to receive financial assistance through the division. 2 of those ways are within the Energy and Mineral Impact Assistance Program, the Discretionary Grant Program, and the direct distribution of severance tax and federal mineral leasing proceeds. And I'll talk about those in a moment, but next, I thought I would show you, Patrick alluded to the various state formulas for how federal mineral leasing flows. In Colorado, we certainly have one. We also have one for severance tax. And this is what the state flow looks like. First, I thought I would share with you, on the top there are 2 blue arrows. These are off the top flows right now with state severance tax. The latest is in the current fiscal year, Senate Bill 255. It's passed both the House and the Senate, and the last I checked, it isn't quite effective, still awaiting a governor's signature, but when it's effective, it will divert one time the first $20 million received off the top to the general fund to help fund the state's TABOR refund for the state 15-16 budget year. Statute also directs on the other side of that green box there at the top, through 2016, $1.5 million annually comes off the top of severance tax to the Colorado Energy Office into their Innovative Energy Fund. But after those 2 off the top diversions, we are looking at the 50-50 split between DNR and DOLA. And here, the places especially relevant, I think, to local governments, the direct distribution within DOLA's half of the state severance tax flow, 30% goes to a formulaic direct distribution to counties and municipal governments. The discretionary grant program is funded out of that remaining 70%. And then in the perpetual fund within DNR, there are various programs, especially CWCB programs for local governments. Another piece I wanted to share with you, because it's relatively new, well, the legislation was from 2019, but the flows haven't triggered until last fiscal year. There is, when the perpetual fund hits 50 million in DNR, the next 10 million overflows into a grant program at CDPHE for small community water and wastewater grants. It triggered last year, and it will likely trigger this year as well. Now, federal mineral lease proceeds, here is what the state's flow of federal mineral leasing proceeds look like. As Patrick mentioned, 49% comes to Colorado, and the legislature makes a distinction in how we distribute this money between bonus and non-bonus revenue. Bonus revenue is split 50-50. Some goes to higher ed. The other half goes into a local government permanent fund. And then on the non-bonus side, 1.7% goes to a school district direct distribution that DOLA administers. And 40% goes then to the Local Impact Program, or the Energy and Mineral Impact Assistance Program. That's split 50-50. Half goes to the Discretionary Grant Program, and half goes to direct distributions to counties and municipalities, and in some cases, including in Garfield County's case, instead of to the county government, it is distributed to a federal mineral leasing district. And here is the opportunity then for the legislature, in instances where it's expected that federal mineral leasing revenue will be 10% or greater decline in the next year, the legislature can choose to appropriate from this permanent fund to backfill the direct distribution portion of that. And it's happened one time this most recent year, and because of some legislative housekeeping, sometimes when you pass language and then realize, oh, that language wasn't quite right. So unfortunately, this past time, it had to be in a separate distribution. Ideally, and the intent in the future will be to have that be part of the regular annual direct distribution if that backfill ever happens. And then another kind of temporary piece of this flow right now was from last session. Senate Bill 46 directs DOLA to transfer $3.25 million a year to the Division of Fire Prevention and Control for a local firefighter safety program to local fire departments. All right, here is a map of, these are direct distribution and grant awards from July 2012 through the end of 2014, and shows both, again, grant awards and direct distributions. The grant program was created by the legislature in 1977 to assist political subdivisions that are socially or economically impacted by the development, processing, or energy conversion of minerals and mineral fuels. Through this program, you have discretionary grant program, the formulaic direct distributions. Statute also permits the department to make loans to local governments for water or sewer projects. There is a minimum 5% loan interest rate in statute, so given the interest rate environment right now, that's not terribly active. This map and all kinds of other details available on our website, and at the end I'll show you how to get that. The grant program has 3 application cycles a year, April 1st, August 1st, and December 1st, and each cycle then has a corresponding hearing when applicants can present details of their projects to a statutory Energy and Mineral Impact Advisory Committee, and then this advisory committee makes recommendations to the DOLA Executive Director. And each May, that advisory committee has a policy meeting, so one's coming up here in the next couple of weeks, and at that policy meeting they'll determine grant amounts per cycle for the coming fiscal year based on expected severance tax and FML revenues to the program. Currently, each grant cycle has $35 million available per cycle. Here is a look at the types of projects awarded for the discretionary grant program, again from July 2012 through December 2014. The program is awarded about $150 million. Roads, public facilities, water and sewer projects are the most popular programs, most common programs. Now on to direct distribution. This is a formulaic distribution that happens once a year by August 31st, so by the time banking happens, you'll see the deposits in the first week of September each year. On the severance distribution, the pool of money at the department starts, and then we allocate it into county pools based on employee residence reports, mining and well permits, and mineral production. And then each county pool is distributed to the county government and all the municipalities within that county based on each government's proportion of county totals of employee residence reports, population, and road miles. And the statute sets factor weights for each of these. And the statute requires at the county pool level for employee residence report, mining and mineral permits, and mineral production, each of those to be weighted 30%. And the executive director then, after consulting the Energy and Mineral Impact Advisory Committee, sets that discretionary 10% to one of those factors, or a combination. And since the legislation changed the program and these formulas in 2009, the executive director has set that discretionary 10% piece in the employee residence report factor. The sub-county factors do not have any factor weight parameters, and those have historically been set even between the three. For federal mineral leasing, the county pools of money are distributed first to county pools based on employee residence reports, and here, as Patrick alluded to, we do have the data to determine what county, where the federal mineral leasing revenue is coming from. So the federal mineral lease generated is the other factor. I don't know. And then the sub-county allocation is happening with the same factors: employee residence report, population, and road miles. Statute requires that the Colorado employee residence report factor not be weighted more than 35% for federal mineral leasing direct distribution. So conversely, the FML revenue generated cannot be weighted less than 65%. And those minimum and maximums have historically, thus far, been where the executive director has set those. The sub-county allocation of federal mineral leasing proceeds have been evenly weighted as well. And then that smaller school district direct distribution happens with the same factor weights as the county municipal FML district direct distribution. On this side, though, if a county has more than one school district, the Department of Education provides us pupil count data, and we allocate among school districts in one county based on pupil count. Now on to forecasts. Economists with both the Colorado Legislative Council for the General Assembly and economists within the state Office of Planning and Budgeting for the governor, within the governor's office, release quarterly economic forecasts for the state. And in those forecasts that they provide quarterly are specifically forecasts for severance tax and federal mineral lease proceeds. And these figures then reflect their most recent forecasts from March. And both agencies forecast strong growth for the current 14-15 fiscal year, after $268 million in severance tax revenue in the prior 13-14 fiscal year. But note that 15-16 column and the change in trend. Legislative Council is forecasting more than a 63% decline from the current fiscal year, and OSPB is forecasting over 61% decline. This is from the Office of State Planning and Budgeting's forecast. Quote, higher prices for natural gas and growing oil production in the beginning of 2014 are driving continued strong severance tax revenue growth for fiscal year 14-15. Falling prices for both resources, combined with ad valorem tax credits, will result in a decline of $227.3 million in severance tax in fiscal year 15-16, end quote. So I guess if there's one takeaway from my presentation today for local governments, I I hope it's this expected decline in severance tax for the next fiscal year. Sorry. For federal mineral leasing proceeds, they are forecasting a slight decline in revenues for this source, but note that federal mineral leasing proceeds are far less volatile than severance tax. So this then begs the question, why is severance tax so volatile? Well, state severance tax collections come from production on coal, metals, and oil and gas production accounts for the vast majority of the revenue source. And the variability in state severance tax comes from this this piece of severance tax for oil and gas. Here is a look at the swings from year to year in the annual percent change of severance tax to the state. And you can see from the vertical axis there just how big these year-to-year percent changes can be. And the oil and gas formula itself provides some of this detail. You start with production quantity and remove production from stripper wells and apply the oil and gas price. And then the processing and manufacturing costs are subtracted, apply the statutory severance tax rate, and then the severance tax liability can be reduced by the property tax credit. And depending on the property tax mill levy applied where the production occurs, the credit can potentially greatly reduce this net severance tax liability. This kind of is a very basic, simplified example to look at the mechanics of how this works. The blue line shows the hypothetical production value, which changes from year to year based up both on price and production volume. The orange line shows the assessed value, which happens a year after the production. And then the white line shows the property tax collected another year after that. So there's a 2-year lag to local governments on production. And there's a 2-year lag. And then when that property tax credit, which is 2 years behind, can be applied to the severance tax liability, you could have a change in the production value in that time. Here's another way to look at it. You can see the color coding shows the matching production and severance tax and property tax tied to it. And the property tax lag creates the volatile effective severance tax rate applied to a volatile tax base. So what does this variability mean for local governments? In terms of the Energy and Mineral Impact Assistance Program. For grants, DOLA policy and the advisory committee recommendation is to mitigate these swings with uniform grant availability per cycle. But for direct distributions, for local governments that rely on this revenue, it can be more challenging. It certainly is an irregular revenue source due both to the volatile nature of severance tax and also because so many variables, as we saw, go into the formula. There's all kinds of technical assistance available out there for finance and budget directors. One I really like by the National Advisory Council on State and Local Government Budgeting, and this is available for free at the Government Finance Officers Association website. One of the elements in here is about the evaluation of the use of unpredictable revenues, including those mineral-derived revenues. And some of the takeaways from this are consider the effect that this variable revenue source can have on the services you provide if you're using it for operations, though the department does caution local governments to rely on this variable revenue source too much for operations. Take into account the unpredictable nature, get a sense of the degree of volatility in the revenue source. And as a board, sometimes I would say it's a good idea, especially the larger this revenue source is for your local government, to maybe even set a policy on the agreed uses of the revenue or the actions that you would take in the event the revenue source is way high or low compared to your expected receipts. And set contingency planning, and of course do this in a public setting. There's all kinds of resources available on the DOLA website, including historical funding decisions, program guidelines for the grant program, and direct distributions. Here's our website, and up here at dola.colorado.gov, the Division of Local Government, and then on the side a menu will pop up. Under financial assistance are the direct distribution and grant program links. And then if you're interested in applying specifically or especially to the grant program, our 8 regional managers are fantastic resources, and the top menu there is for contact information for the regional managers. Thank you.